Welcome back to the Wolf of Property and Casualty. I'm your host, Derek Lasniak, with over 15 years of commercial broking experience focused on the middle market, upper middle market, and national account space. Today, we're going to talk about a topic that is really critical, specifically on the safety side of the experience modification factor. And for brokers out there, this is one of those moments where you get to take out for a spin a lot of super fancy words that make you sound super smart. And so if you listen in as I talk about this today and how I sold this and how I manage experience mods for my clients, there's not only the opportunity to, in 15 minutes, get a crash course on what's important and how you can be successful in utilizing this, but also, and what I think is really interesting is you can sound like you know what the hell you're talking about, because while the experience modification factor is an incredibly complex, in-depth calculation, it's really not that difficult. And when you think about how you distill it down to talk to a buyer, a CFO, or a safety person, or an HR professional, there's really some key points that I think are really important. Let's dive in. So, experience modification factor, what is it? Well, it's a really complex equation, and it's a complex equation that is looking at the loss history of incurred losses over a 3-year window of an organization. And so let's unpack a couple of those words. Incurred losses means losses both paid and reserved on your workers' compensation policy. So it doesn't necessarily only mean the ones that are closed and paid. What does it mean by 3-year window? Well, it skips what we call the green year. So you're looking at 3 years of data associated with an organization and their performance on their work comp program for incurred losses, but we're going to skip the most recent year. So if we're talking about an account that is currently in their January 1st, 2025, January 1st, 2026, their experience modification factor, and I used to suck at this, I used to have to write it down, is going to be based on 24, 25, 23, 24, 22, 23. You're skipping the most recent year. And you might say, why do they do that? I mean, if I got a company that's trending in the right direction, why wouldn't they just take the most recent data, especially in a world of digital updates and online and AI and all that shit? Well, the reality is that claims take a while to settle. Now, your shoulder injury, your shoulder rotator cuff surgery is going to take 9, 10, 12 months to pay out. And so claims that are just reported are too green. They're too fresh. If you think about how a work comp adjuster is managing a work comp claim, they're being asked to put up a reserve in the first 24 hours of getting that claim in their hands. That reserve, it's not a guess, but they don't know what's it going to take. They might say, hey, this claim is going to take physical therapy, 6 sessions, and I hope they get better and everything's good. And all of a sudden, after 4 sessions, it's not working and now they need surgery. Claims that are vulnerable, or claims that are have a high likelihood of changing their dollar amounts, you almost don't want that lack of confidence stuffed into a metric that is so important. So 3 years of data skipping the most current year. Your experience modification factor is going to be determined by different governing bodies of work comp, different bureaus. If you are a multi-state risk, meaning you have operations or FEINs or employees in multiple states, you are likely to have an experience modification factor that is promulgated. That's a ding, ding, ding for fancy words to use to make you sound smart. Promulgated is just another word for calculated. For some reason, we use that with the experience mod, and it makes you sound like you know what you're talking about. But if you have multi-states and employees in multiple states, you're typically going to have the National Bureau. The NCCI is the name of that organization. I think they're in Florida, and they will produce an experience modification factor for you once a year. In some states, if you're a single employer in a single state, take Wisconsin, for example. In the state of Wisconsin, you get your experience mod promulgated by the WCRB, which is the Wisconsin Bureau for Work Comp. Some states are even more unique. Even if you're a multi-state risk, but you have exposure to California, California will apply a separate mod from what the National Bureau is. So pay attention to that. Obviously, the state that you're working in, you're going to have a good feel for what the promulgation and the governing body is. But typically, the easy way to think about it, multi-state risks are always going to be NCCI driven, and individual states are typically going to be in that bureau within that individual state. The things that are most important about experience modification factor, and this is how I described it to my customers, because again, I sold a lot to CFOs, and your work comp program may or may not, especially in the middle market space, have a lot of influence from your HR department or your safety department. And they probably care about the experience modification in a slightly different way. They look at that number and they say, it's a trend for how we're performing safely. Keep in mind your audience and how you talk about things as important as the experience mod. The experience mod, when you talk to a CFO, I would use the term multiplier. CFOs think in terms of finance. So your experience modification factor is going to range. Typically, there's a minimum. The mod is going to have a minimum based upon the industry that you're in. Let's just say that that minimum is a zero point 0.5, and it can go up to, call it 2.5, 2.5, or 3. I've seen a client who was, north of 2. And when I say multiplier, because when I'm talking to a CFO, I'm saying, look, your work comp premium. And again, the experience modification factor is traditionally a middle market, small business, smaller commercial space. Because once you get into the world of loss sensitive programs, retrospective rating programs, and even captives, your experience modification factor, well important and well being promulgated in the background, is not necessarily going to be as critical to the price and or the function of your work comp program. But when you have a guaranteed cost program, aka you pay a certain amount of money based upon your payroll, and in exchange for that, the carrier takes on all the risks of your losses, and your set amount, and you move on. In that world, it's a multiplier, because once I take your payroll times the rate and drag it all the way to the bottom, and I have your premium based upon the rates and the payroll, that multiplier, if it's a zero point 0.5, that means that your premium gets cut in half. If it's a 1.5, that means your premium is going to be tagged up 50%. So what's the difference between 1.5 and zero point 0.5? Well, again, we're looking at 3 years of loss data on your work comp program. And when we look at those 3 years, if you're a high performer, again, relative to your peers. So if you're a zero point 0.5, that means you're performing at the epitome. You're the top 1% of the 1%. Hence, you get a 50% discount, because that's going to reduce your premium, because you need less premium to cover the expected losses. Again, this is an actuarial number. It's essentially saying, based on the 3 years we looked at, your premium comes out, your standard premium, payroll times rate equals premium, your standard premium comes out to $300,000. Based on the last 3 years, we only need like $150,000 to cover your expected losses. Therefore, you're going to get that savings on the front end, which becomes a cash flow advantage. Likewise, if you suck or your losses are shit, you're going to get over 1.0. You're going to get to 1.5 or 2. And now all of a sudden you're paying more in terms of premium. I worked a lot in a space where work comp programs routinely were, 30 to 40% of premiums within the program, 2, 3, 4, 5, 6, 7, $800,000. And if you're paying 50% more than what you should based on average, that's going to get the attention. So using the word multiplier with CFOs, well, you might talk to an HR or a safety representative to say, hey, let's dive into the losses. We're going to get a lot tighter on what's driving your high experience mod. But just at first blush, if you're a 1.5, you've had some bad loss years. Hey, this year might be trending great. I can't tell that from here. But what I can tell is that you had a 3-year chunk in the last 4 years that has not been doing so good. And so remembering how you explain it in layman's term, because otherwise it's just this anecdotal number. But when you think about it as a multiplier in terms of the financial impact, it's an easier conversation, especially as you're having those with your primary buyers. The experience modification factor could have its own show. And frankly, I spent a lot of time when I was young getting into the actual equation, trying to understand the inputs. There's things that I think are really important, especially if you're a broker or a buyer, that I think you need to know. Unless your entire day is a claims professional or you live and die by experience mods, I think what you need to know is that the experience mod is designed to punish certain things, meaning it's not dollars in, dollars out. Certain types of losses that go into your experience mod are going to be punished a third more than other types of losses. So the biggest things, the 2 things that I talk about with everybody is, number 1, frequency. One of the laws of risk management is that frequency breeds severity. Thereby, the experience modification factor it's a tool used to punish low performers. And so if I think low performers not only have lots of dollar amount of losses, but I also think that those losses come in frequency, I'm going to weight the calculation of the experience modification factor to say $10,000 losses is going to have a greater weight than one $100,000 loss. And the philosophy behind this is, say, you buy insurance because shit happens. An accident can happen, and a bad accident can happen. So one single $100,000 loss, it's kind of what we're here for. It's kind of what we buy insurance for. But if you have $10,000 losses, that shows me that you've got a frequency problem. You're not addressing safety in real time, and you're that much closer to having a very large loss. The second thing that the work comp experience modification factor is specifically going to punish is lost time, indemnity claims versus medical only claims. And again, it's going back to keeping employees safe. There is going to be a reward for not having employees miss work because of their injuries. And so there is a huge emphasis on lost time or indemnity style claims, meaning typically in most states, you're missing 2 to 3 days of work. And so, again, if you have a lot of claims that where you're not getting people back to work, even doing light duty, the experience modification factor is not just going to look at the total amount, but it's going to put a higher value on those lost time claims, thereby resulting in more increases to that experience modification factor. That's kind of a crash course. In my professional world, we would have a separate meeting associated with diving in to the nuts and bolts of your experience mod. That meeting would typically include maybe the main buyer finance, but typically it's going to spend a really large amount of time with the person in charge of claims, the person in charge of safety, and typically somebody from the HR functions. But importantly, brokers out there, here are the ways that I use the experience modification factor to service my clients and to sell more insurance. What they care about is performance. And so when you look at things inside of an insurance program, especially dollar amount things, they're looking for easy numbers that they can say, are we doing good or bad? Hey, did my premium on my so many clients will say my premium went up 8% and they'll ignore the fact that they grew 20%. So catch on to the things that they can reference really quickly. An experience modification factor is a badge that you can wear on your shirt. If you're under 1.0, I've never met a client that didn't know that number. I'd have I would have all these important statistics and figures that I'd want my CFOs to know, but more often than not, they wouldn't remember them because they weren't important. But most of my CFOs would know exactly what their experience mod is. Maybe because they tied it to the cost of their work comp program, or because it was low and they were really proud of it. I had multiple clients that were in the plans, and they wore it as a badge of honor. For you brokers out there, if you have clients or buyers out there, if you have a low experience modification factor, that's something to celebrate. Just because you're buying insurance doesn't mean that you're also not bidding jobs yourself. So, as a buyer, when you think about a competitive landscape for whatever you're selling, and you're selling value and quality, and you're selling a story about your organization and your product, don't you have a piece in there when you're competing on an RFP about we're a safe organization or we take care of our employees? Well, one of the easiest ways, if I'm telling you that the experience modification factor is a universal number that everybody in every industry recognizes, if you got a 0.56, why not celebrate that when you're talking to your customers? And so, what I would do for my high performing accounts is I would create a one page kind of highlight sell sheet. And I would put it on our letterhead. Now getting some free advertising. And I would give it to my clients and say, hey, next time you're bidding on a job or next time you're talking to your customer, why don't you slide this in here? This is a one page highlight of why your experience modification factor is so low. It's up to you. Maybe you want to tell your customer that you can reduce costs of what your product is because you pay less in work comp. Maybe you want to highlight that you have an awesome return to work program and your indemnity losses are zero. I have now given my clients something they can use in their business, and it's something that I know a lot about. I'm now connecting insurance to a value add to their sales proposition. Double check the math. In my old firm, we had somebody who has worked there for 30 years. She was the godfather of experience modification. She built our platform. She built the program in which we would display experience mods to our customers and dive deep on them. And one of her amazing traits is that she knew everything about the experience mod. I'm going to let you in on a little secret. Just because a national bureau or a bureaucracy is telling you what your experience mod is, doesn't mean that they get it right. We would find errors in the promulgation of experience mods all the time. And errors aren't necessarily the fault of an actual error or a mistake made by the program. A lot of times, errors are just timing. So your experience modification factor, if you're a 1/1 renewal date, the snapshot that they take to promulgate your experience mod on 1/1 is 6 months before your renewal date. So if we're coming up on a 1/1/27 renewal, your experience modification factor is going to be promulgated, calculated based upon what your losses look like on June 1st of 2026. Well, what happens if my losses go down? What happens if I had all these open losses, even though they were 2 years ago, plenty of open losses? What happens if the reserves were way too high because I got a crappy carrier? What happens if the reserves were wrong and someone got healed a lot quicker and the claim that was incurred, reserved and paid for 150,000 closed at 50? Well, what if that $100,000 is the difference between my mod being a 1.0 and a 0.98? Now, 2% of my premium can equate to savings on the front end. They will not automatically recalculate it. Once that snapshot's taken at 6/1 of 26, you're locked in unless somebody is going back, looking and telling and prompting. And that requires going to the insurance carrier that owns the loss, getting them to correct it, and then going to the bureau and asking them to repromulgate the mod. And you have up until a month after your renewal date to do that. It's called the aggravated inequity rule. Ding, ding, ding. Another way to sound really smart. And so take advantage of that, automate that. We had a great system to do that. And I think over like, I don't know, a 5, 6 year span, we saved clients $4 million. I would use this as a prospecting tool. So now I'm transitioning from clients to prospecting. If I would have a prospect that would let me take a look at their losses and take a look at their experience modification factor, and I found that their broker was asleep at the wheel and they missed that there was a point or two, 2% on a $500,000 premium is real money. That's 5 grand, 6 grand, whatever the number is. And so it's an easy task to do, and it makes you look like you are paying attention to the details. The second thing for prospecting about experience modification factors is depending on the state and depending on the access you have, you can get access to an experience mod worksheet or at least look up when the experience mod is effective on prospects. That'll give you an idea of their effective date. Now, not everyone's work comp renews with the rest of the program, but if you're trying to build a sales cycle around a prospect and they're shutting you out in terms of when their renewal date is, now you can get some inside baseball if you just dig around on these websites. It's really a nice tool to have. Leverage that data that goes into it. Leveraging that data to drive loss control and risk management is a huge piece. Whether you have it displayed in a report or not, I told you the two biggest factors that move the mod up and down. At a minimum, you should have an idea. Does my client have a frequency problem or a severity problem? Does my client have a lost time or indemnity or a medical only problem? Just knowing those two things can make you sound at the top of your head, hey, Mr. CFO, your experience modification factor is a 1.2. It's mainly driven from the 2 years of the three before the most recent year. We really had 3 lost time claims that were really bad. This year, we're trending to not have any lost time claims because of the new return to work program that we put into place. So this is a lagging indicator that I think we've nipped in the butt, and therefore I think we're headed in the right direction. And I expect that 1.2 will come down in subsequent years. Now you have a quick spiel. You don't know everything about every claim, but you're good to go. The last thing I'll talk about in terms of servicing customers, in terms of something that gets overlooked and missed, I think, in the prospecting realm, is because the experience mod is a universal language, and it's oftentimes the number that most CFOs and CEOs even care about, try to have it early. So if the experience mod for Wisconsin accounts, for example, you might get your experience mod factor if you're a 1-1, you might get it in October, depending on how busy they are or whatever. But you know that snapshot was taken 6-1. So work with your organization if you have the ability, predict that experience mod 6 months out. Now you're delivering to them something before they're even getting it from the bureau. Now it's a value added service. And a lot of times, if you're doing the work on experience mods, you already know what it's going to be. We were able to predict this with a high degree of accuracy and then deliver it to the client and say, hey, by the way, with a 99.8% confidence level, your experience mod 6 months from now is going to be 0.87. Now we did something before that was told to them. If you just wait for your client to get a note in the mail from the bureau and then you're asking them, hey, do you have the experience mod worksheet? They're going to say, don't you know what my experience mod is? Or if you're asking an underwriter, hey, did you get that mod worksheet yet? Now it's like, what do you mean? This is a big time customer. You don't have any idea what their experience mod is. So again, complicated topic, but I wanted to distill it down into the areas that I focused on and how I use this as a tool to both service my customers and specifically in the new business realm.